Hello everyone, welcome back to Hash Commerce and Dollar Accounting. In our last session we discussed, but what if our trial balance doesn't tally? What if we find mistakes in our accounts? Today, we are diving deep into. So, let's get started. Even after maintaining proper books of accounts, mistakes happen. These mistakes can lead to incorrect financial statements and wrong decision-making. That's why understanding how to errors is crucial for every accountant. Suppose a salary payment of 10,000 rupees was wrongly recorded as 1,000 rupees. This mistake needs to be corrected before preparing the final accounts. That's where rectification comes in. Now, errors in accounting can be classified into four major types. Let's understand them with simple examples. When a transaction is completely or partially omitted from the books, a sales invoice of 5,000 rupees was never recorded. The trial balance will not be affected, but the final accounts will show incorrect figures. When an entry is recorded incorrectly, such as the wrong amount or wrong account, goods sold to Amit for 3,000 rupees were wrongly recorded in Sumit's account. One personal account is affected, but the trial balance may still match. When an accounting principle is violated, such as treating revenue expenses as capital expenses, buying furniture worth 20,000 rupees but recording it as an expense instead of an asset, financial statements will show incorrect profit or loss. When two or more errors cancel out each other, making the trial balance appear correct. If sales are understated by 1,000 rupees and purchases are also understated by 1,000 rupees, the trial balance still matches, but the final accounts will be incorrect. Once we identify an error, how do we correct it? It depends on when the error is found. Simply correct the original entry in the respective ledger accounts. Use a suspense account to make adjustments if needed. Adjust the error in the next accounting period. If rent expense of 5,000 rupees was wrongly recorded as 50,000 rupees, we need to correct it either by direct rectification or through the suspense account. Now let's see how to correct these errors. The method depends on whether the trial balance is affected. Simply make an additional entry to correct the mistake. If rent paid 5,000 rupees was wrongly debited to the wages account, the correction entry will be rent account Dr. 5,000 rupees, to wages account 5,000 rupees, correction of wrongly debited rent. Use a suspense account if the difference is unknown. Once the error is identified, correct the specific accounts and close the suspense account. If 1,000 rupees was wrongly added to the sales account instead of 10,000 rupees, the rectification entry will be suspense account Dr. 9,000 rupees to sales account 9,000 rupees. Correction of excess sales recorded. Errors in accounting can lead to wrong profit calculations, tax issues, and even legal troubles for businesses. So, rectifying errors is not just a textbook concept. It's crucial for every accountant and business owner. In 2018, a major company had to restate its financial statements due to accounting errors leading to a loss of investor trust and stock price decline. This shows why accuracy in accounting is critical. So, to wrap up today's session, errors happen, but they must be corrected before finalizing accounts. Understand the types of errors to identify and rectify them correctly. Use the right method depending on whether the trial balance is affected. Always maintain accuracy in accounting to avoid financial discrepancies. I hope you found this session helpful. If you did, don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more such in-depth lessons. See you in the next video. Until then, keep learning and keep growing. Let's dive deeper into practical examples of rectifying errors in accounting. We'll go through several case studies to understand the real-world application of these concepts. Stay tuned. Case Study 1. Correcting an error of omission. Imagine a situation where a sales transaction worth $500 was completely omitted from the books. The rectification process would involve recording the missed transaction in the sales journal and updating the ledger accounts accordingly. Case Study 2. Correcting an error of commission. Consider an error where a payment of $200 meant for supplier A was mistakenly recorded under supplier B. To rectify this, you would need to debit supplier B's account and credit supplier A's account with the same amount, thereby correcting the mistake. Case study 3. Correcting an error of principle. Suppose a purchase of office equipment worth $1,000 was incorrectly debited to the office supplies expense account instead of the office equipment asset account. The rectification would involve debiting the office equipment account and crediting the office supplies account to reflect the correct classification. Case study 4. Correcting a compensating error. Imagine two errors that cancel each other out: an understatement of revenue by $300 and an understatement of expenses by $300. Although the trial balance might still tally, these errors distort the financial statements. Rectifying these would involve correcting both the revenue and expense accounts to their accurate figures. By examining these real-world scenarios, you can see how crucial it is to identify and rectify errors promptly to maintain the integrity of financial records. Case Study 1. Rectifying an error of omission. Suppose a sales invoice of 10,000 rupees was never recorded. We'll see how to identify and correct this error. First, identify the missing transaction by cross-referencing sales records with the sales ledger. In this case, a sales invoice worth 10,000 rupees was omitted. To rectify this, you need to make an adjusting entry. Record the missed sales transaction by debiting the sales receivable account and crediting the sales revenue account with 10,000 rupees. This ensures that both the sales and receivables are accurately reflected in the financial statements. By doing this, you maintain the integrity of your financial records and ensure that your financial statements provide a true and fair view of the business's performance. Now let's move on to case study 2. Rectifying an error of commission. Imagine goods sold to Amit for 5,000 rupees were wrongly recorded in Sumit's account. We'll correct this mistake step by step. First, identify the incorrect entry. In this case, the sales to Amit were mistakenly recorded in Sumit's account. This error results in an incorrect representation of both Amit's and Sumit's accounts. To rectify this, you need to make two adjusting entries. First, reverse the incorrect entry by debiting Sumit's account and crediting the sales revenue account with 5,000 rupees. This removes the incorrect entry from Sumit's account. Next, record the correct entry by debiting Amit's account and crediting the sales revenue account with 5,000 rupees. This ensures that the sales to Amit are accurately reflected in the financial statements. By following these steps, you correct the error of commission and maintain the accuracy and integrity of your financial records. Understanding how to rectify such errors is crucial for accurate financial reporting and analysis. Now let's move on to our closing scene. Now let's move on to case study 3, rectifying an error of principle. Imagine that furniture worth 20,000 rupees was mistakenly recorded as an expense instead of an asset. This kind of error can significantly impact the financial statements, as it affects both the balance sheet and the income statement. First, identify the incorrect entry. In this case, the purchase of furniture was wrongly recorded as an expense, which means it was debited to an expense account rather than an asset account. This mistake reduces the net income and undervalues the assets. To rectify this error, you need to make two adjusting entries. First, reverse the incorrect entry by crediting the expense account and debiting the furniture account with 20,000 rupees. This removes the incorrect expense entry and correctly categorizes the furniture as an asset. Next, record the correct entry by debiting the furniture account and crediting the cash or accounts payable account with 20,000 rupees. This ensures that the furniture is accurately reflected as an asset on the balance sheet and does not incorrectly reduce the net income. By following these steps, you correct the error of principle, maintaining the accuracy and integrity of your financial records. Understanding how to rectify such errors is crucial for accurate financial reporting and analysis. Now, let's move on to our closing scene. Let's dive into case study 4, rectifying compensating errors. Compensating errors occur when two or more errors offset each other. For example, if sales are understated by 1,000 rupees and purchases are also understated by 1,000 rupees, the net effect on the overall financial statements might seem negligible. However, these errors still need to be corrected to ensure the accuracy and integrity of the financial records. First, identify the errors. In this scenario, the sales account is understated by 1,000 rupees, and the purchases account is understated by the same amount. To rectify these errors, you need to make two adjusting entries. Start by correcting the sales error. Debit the sales account by 1,000 rupees to increase it to its correct amount. Then credit the accounts receivable or cash account by 1,000 rupees, depending on whether the sale was made on credit or for cash. Next, address the purchase's error. Debit the purchase's account by 1,000 rupees to reflect the accurate amount of purchases made. Then, credit the accounts payable or cash account by 1,000 rupees, depending on whether the purchase was made on credit or paid in cash. By making these adjusting entries, you ensure that both the sales and purchases are accurately recorded, which in turn maintains the integrity of your financial statements. Correcting compensating errors is essential for accurate financial reporting, even when the net effect appears to be zero. Understanding how to rectify such errors is crucial for maintaining the trustworthiness of your financial records. Now let's move on to our closing scene. Now let's delve into some advanced techniques in error rectification. Professional accountants often rely on sophisticated tools and methods to ensure errors are identified and corrected efficiently. One widely used technique is the use of accounting software with built-in error detection algorithms. These programs can automatically flag inconsistencies and discrepancies, significantly reducing the risk of human error. Another advanced method is the implementation of internal controls such as regular audits and reconciliations. These practices help to catch errors early and ensure that financial records are accurate and reliable. Additionally, forensic accounting is an advanced field where specialists use investigative techniques to identify and rectify errors, particularly in cases of fraud or financial misconduct. Data analytics is also becoming increasingly important in error rectification. By analyzing large data sets, accountants can identify patterns and anomalies that may indicate errors. This proactive approach allows for faster and more accurate corrections. Understanding and utilizing these advanced techniques can greatly enhance the accuracy and integrity of financial records. As technology continues to evolve, so too will the methods we use to ensure our financial data is error-free. Now let's move on to our closing scene. Gap 2S. Visual. Transition to a new segment with a title card, Common Pitfalls in Error Rectification. Gap 3S. Visual. Animated graphics of an accountant looking stressed at a desk with a pile of documents. Narrator. Even the most experienced accountants can fall into common pitfalls while rectifying errors. One frequent mistake is failing to identify the root cause of the error. Simply correcting the symptom without understanding the underlying issue can lead to recurring mistakes. Gap 3S. Visual. Animation of an error being corrected, but the same error reappearing in subsequent records. Narrator. Another pitfall is overlooking the impact of the error on related accounts. Errors in one account often affect others, and failing to consider these connections can result in incomplete rectifications. Gap 3S. Visual graphics, showing interconnected accounts with one error affecting multiple areas. Narrator. Time pressure can also lead to hasty corrections. Rushing through the rectification process increases the risk of making additional errors, which can compound the original problem. Gap 3S. Visual. Animation of a clock ticking faster and an accountant hurriedly making entries. Narrator. Additionally, relying solely on automated tools without manual verification can be problematic. While technology is incredibly helpful, it's not infallible. Always double-check automated corrections for accuracy. Gap 3S. Visual. Split screen showing an automated tool flagging an error and an accountant verifying it manually. Narrator. Lastly, inadequate documentation of corrections can create confusion and hinder future audits. Always keep detailed records of what was corrected and why to ensure transparency and accountability. Gap 3S. Visual. Animation of an organized filing system with well-documented correction logs. Narrator. Avoiding these common pitfalls requires a combination of thorough analysis, attention to detail, and a balanced use of technology and manual oversight. By being aware of these potential mistakes, you can ensure a more accurate and reliable rectification process. Gap 3S. Visual. Transition to the closing scene with a smooth fade-out. Narrator. Now let's move on to our closing scene. Narrator. Welcome to our Quanda session, where we'll address some frequently asked questions about rectification of errors in accounting. If you have any questions, feel free to leave them in the comments section below. Visual. Transition to an animated text that reads, Quanda session, your questions answered. Gap 3S. Visual animated graphic of a question mark and a speech bubble popping up. Narrator. Question 1. What should I do if I find an error after the financial statements have been published? Gap 2S. Visual. animation of financial statements and an error being highlighted. Narrator. If you find an error after the financial statements have been published, the first step is to assess the materiality of the error. If it's significant, you may need to issue a restatement. Always consult with your auditor or financial advisor for the best course of action. Visual. Transition to another animated text that reads Question 2. Gap 3S, visual animated graphic of a question mark and a speech bubble popping up. Narrator, Question 2, how can I prevent errors from occurring in the first place? Gap 2S, visual. Animation of an accountant implementing checks and balances. Narrator. Preventing errors starts with a robust internal control system. This includes regular reconciliations, segregation of duties, and periodic audits. Training your staff and keeping them updated on accounting standards can also help in minimizing errors. Visual transition to another animated text that reads Question 3. Gap 3S, visual, animated graphic of a question mark and a speech bubble popping up. Narrator, Question 3, what are some best practices for documenting error corrections? Gap 2S, visual, animation of an organized filing system with detailed correction logs. Narrator. Best practices for documenting error corrections include maintaining a log of all corrections made, detailing the nature of the error, the accounts affected, and the steps taken to rectify it. This documentation should be easily accessible for future reference in audits. Visual, transition to another animated text that reads Question 4. Gap 3S, visual, animated graphic of a question mark and a speech bubble popping up. Narrator. Question 4. Can software tools completely eliminate accounting errors? Gap 2S, visual, animation of an accountant using software tools alongside manual checks. Narrator. While software tools can significantly reduce the likelihood of errors, they are not foolproof. Manual oversight is still essential to catch any discrepancies that automated systems might miss. A balanced approach using both technology and human verification is the best strategy. Visual. Transition to a closing card with a smooth fade-out. Narrator. Thank you for joining our Quanda session. We hope these answers have been helpful. Don't forget to leave your questions in the comments section and we'll do our best to address them in future videos. Now let's move on to our closing scene. Narrator. As we wrap up this comprehensive guide on the rectification of errors in accounting, let's take a moment to summarize the key points discussed in this video. Visual. A summary board with bullet points showing types of errors, stages of rectification, methods of rectifying errors, and real-world impact. Narrator. First, we explored the different types of errors you might encounter, including errors of omission, commission, principal, and compensating errors. Understanding these categories is crucial for identifying and rectifying mistakes effectively. Visual animated icons representing each type of error. Narrator. Next, we delved into the stages of rectification, emphasizing the importance of catching errors early and the distinct approaches required for errors found at various stages, from trial balance to post-final accounts preparation. Visual. A timeline showing the stages of rectification. Narrator. We also covered the methods for rectifying errors, both those that affect and do not affect the trial balance. Practical examples and case studies provided real-world context to these concepts. Visual clips from previous scenes showing methods and examples. Narrator. Additionally, we discussed the real-world impact of accounting errors and shared advanced techniques and common pitfalls to avoid an error rectification. Visual real-world scenarios and a checklist of advanced techniques. Narrator. To further aid your learning, we've compiled a list of additional resources including articles, books, and online courses, which you can find in the description below. Visual list of resources with URLs displayed. Narrator. Thank you for joining us on this deep dive into the rectification of errors in accounting. We hope this video has been both informative and practical, equipping you with the knowledge to handle accounting errors confidently. Visual. Smooth transition to a closing card with a thank you message and a call to action to like, share, and subscribe. Narrator. Don't forget to like, share, and subscribe to our channel for more insightful content. Until next time, happy accounting. Visual. Fade out with background music and channel logo animation. Visual outro with background music and channel logo animation.